Hey everyone, and welcome to this explainer. I am absolutely thrilled you're joining us today because we are tackling what I think is one of the most fascinating puzzles in the whole financial world. When we look at a successful business, we usually just see the final results, right? The massive successes, the occasional failures, the steady growth. But behind the scenes, there is this massive, quiet engine of calculation and prediction driving every single major move. Today, we're exploring the absolutely critical topic of risk analysis. How do organizations figure out if a massive $100 million investment is actually going to pay off or if it's going to drag them completely under? We're going to map out exactly how risk and uncertainty analysis completes the picture for these decision makers. So get comfortable, focus in, and let's get started. Okay, let's dive into this right off the bat. How do you value an unpredictable future? It sounds almost philosophical, doesn't it? But for managers and financial analysts, this isn't philosophy, it is literal survival. The stakes of business forecasting are incredibly high. Every single time a company decides to build a new factory, launch a whole new product line, or acquire a competitor, they are betting millions, sometimes billions of dollars on a reality that simply hasn't happened yet. They're peering into a fog, trying to put a precise dollar value on tomorrow. Section 1, the core forecasting problem. We are looking at the fundamental challenge of predicting what hasn't even happened yet. So, here's the bedrock truth. All capital budgeting relies entirely on forecasting future cash flows. Basically, every single major financial decision hinges on estimating the money coming through the door months or maybe even years from now. Think about it. Imagine a company deciding to build, say, a massive $500 million EV battery plant. Because the future is completely uncertain, new competitors might pop up overnight, supply chains could just snap. Risk absolutely must be accounted for mathematically. You cannot just cross your fingers and assume the best-case scenario is going to unfold. If you're building a budget based on tomorrow's cash flows, you absolutely need a solid way to brace for impact if things go sideways. Section 2. Let's move to Toolset 1, Adjusting the Numbers, and see how this builds into our financial survival toolkit. When managers face all this uncertainty, they actually tweak the math right at the source. First up, we've got adjusting discount rates. If that new EV battery plant feels super risky, managers will demand a higher rate of return to even consider taking it on. They're basically baking the risk directly into the percentage they use to discount those future cash flows. On the flip side, they might use something called certainty equivalence. Instead of messing with the rate, managers look straight at the projected cash inflows. Say they expect $10 million in year one, well, they might deliberately shrink that down to, say, $6 million, a number they feel completely certain they can hit. It's really just two different ways of forcing the math to reflect a messy reality. Section 3, Toolset 2, Alternate Realities. This is where managers test investments by building entirely different worlds. This specific technique is called sensitivity analysis, and it's a brilliant way to test an investment's absolute limits. Analysts will build out these highly optimistic scenarios. What if lithium prices drop and demand just skyrockets? But then they relentlessly map out the pessimistic extremes right next to it. Like, what if supply chains break entirely and construction costs double? By beautifully juxtaposing these extremes directly against each other, managers see exactly how sensitive their investment is to just a single variable going wrong. It paints this really vivid boundary of what's actually possible. But here's the thing. Just knowing the best and worst case isn't quite enough, right? You need to know how likely they are to actually happen in the real world. That is exactly where probability-based valuation comes in. Managers stop guessing and start assigning concrete, solid percentages to those alternate realities. Maybe that total supply chain crisis scenario. Maybe that only has a 15% chance of happening, while a middle-of-the-road reality sits at a comfortable 60% chance. By weighing the possible outcomes against their actual likelihoods, the valuation becomes incredibly precise. Section 4, Toolset 3, the hard math. Let's shift and check the statistical pulse of an investment here, and don't worry, we are keeping the dense math completely simple and accessible. Now, what's really interesting about this slide is that standard deviation isn't just some abstract high school math concept. It is a pure statistical measure of risk in the business world. When forecasting cash flows, the standard deviation tells analysts exactly how wildly actual cash flows might swing away from what they expect. Think of it like this. If a project expects $1 million in returns, a low standard deviation means you're pretty much going to hit right around that 1 million mark. It's stable. But a high standard deviation, that means you could make 3 million, or you could literally lose $1 million. It takes that abstract gut feeling of risk and turns it into a hard, undeniable number. Okay, let's take a breath here. Because if standard deviation gives you the absolute spread of the risk, the coefficient of variation gives you the risk relative to the return you're expecting. And this is absolutely crucial for scale. I mean, a $10,000 standard deviation is terrifying on a tiny $50,000 project, right? But it's largely meaningless on a $50 million project. The coefficient of variation lets managers compare completely different investments side by side. It determines exactly how much risk they are taking on for every single dollar of expected return. It really is the ultimate reality check. Section 5, the climax, visualizing the path. This is where we bring in the final, highly visual dimension of our toolkit that actually maps out the strategic path forward. All of this analysis we've talked about culminates in one place. As our source material explicitly notes, decision tree analysis adds a visual dimension. Think about how powerful that really is. We are taking all those statistical measures, those scaled-down cash inflows and the probabilities, and we're transforming that abstract math into a tangible visual map that a manager can actually follow. And this brilliantly illustrates how decision trees map sequential choices and outcomes, literally like the branching limbs of a tree. A manager starts right at the trunk with the initial decision to invest. If they choose to launch a product nationally and the market is good, well, that branch leads to a whole new set of expansion choices. But if they pilot it locally instead and the market is bad, it branches off into different retreat options. It lets them see the whole domino effect of every choice before they ever commit a single dollar. And that brings us to our final thought for this explainer. Look, the future will always be entirely unpredictable, and all capital budgeting is going to carry some risk. But by using certainty equivalence, sensitivity analysis, standard deviations, and these amazing visual decision trees, we don't have to just guess anymore. We can actually map the unknown. So, the next time you are faced with a complex, high-stakes decision in a world of uncertainty, which branch will you choose? Thank you so much for joining me today, and keep exploring.